Our first presenter today is going to be Aspen Funds. I'm promoting Ben Fraser to panelist role right now. Ben, there you are. How are you doing this morning?
Doing well. How are you doing?
Pretty good. Ben, tell us a little bit about Aspen Funds and feel free to share your screen and dive into your presentation when you're ready.
All right. Thanks so much, Jimmy, and excited to kick it off here. So, yes, as you said, I'm the Chief Investment Officer at Aspen Funds, and I'll be talking about oil and gas investing today. So, we're going to get right into it with the unique asset class that some people may or may not be familiar with. So, so I'm going to talk about a fund that we've recently launched that is going after diversified holdings in oil and gas, and talk a little bit about where we're seeing opportunity in this space. First off, got to give the disclaimer. This is not a solicitation to sell securities. This is merely informational. You have to review our full private placement memorandum. I will make forward-looking statements and projections, which are not guaranteed, and any past performance is not necessarily indicative of future performance. So with that, a little bit about me. As you said, a Chief Investment Officer, Aspen Funds. We've been around for 10 years, and I've been invested in lots of different asset classes. And so love what you're sharing, Jimmy, and definitely agree that private alternatives are an amazing place to build wealth as investors. So my background before jumping in with Aspen was as actually a commercial banker and a lender for many years, and also run a podcast called Invest Like a Billionaire. Just a little bit about Aspen, because you may not be familiar with us. How we operate is possibly a little bit different than some of the sponsors that you work with. And I liken our approach more to a family office type of approach of investing, in that we're not a hammer and we're, one asset class and everything is a nail. We actually survey the landscape of opportunity across all the different alternative investment opportunities, and really want to look at where are the macro trends supporting the best places to be right now. What are the tailwinds that are going to provide a lot of extra support in this current economic environment? And so with that more agile model allows us to find where we think are the best risk-adjusted opportunities, find the best strategies, and build the best teams around those strategies, and then put together kind of best-in-class investor opportunities. And so one of the commitments, we have 4 partners. I'm one of 4. Our team and our management team invests in every single deal that we put out to investors for kind of true alignment of interests. A little bit of our track record. We've been on the Inc. 5000 for many years, 10-year track record as an operator. I have raised over 150 million, actually approaching 200 million here, 300 million in assets. And my favorite number there on the right is we've sent over $50 million of distributions back to investors since inception. So it's always fun to raise money, but it's way more fun to return capital and profits back to investors. Here's just a little picture of our team. So our 4 partners here, we got Bob, Jim, Dan, and myself. I'm the youngest one of the bunch, which I'm glad for, because there's a lot of experience here that the rest of our team really brings across a lot of different asset classes. So I mentioned that we're kind of asset class agnostic. We're looking for best opportunities, but our partners have backgrounds in development, experience in real estate. We've done a lot of real estate. That's kind of one of the bigger asset classes, and we do a lot there. Private equity, hedge funds, distressed debt, actually where we cut our teeth in over 11 years ago. And oil and gas. This is something we've been investing in for several years now, and we think is really one of the premier opportunities from a timing standpoint of really any of these asset classes. I'm going to explain why here in a sec. You got to give the shameless plug here for our podcast. We have a podcast that we really enjoy doing called Invest Like a Billionaire, and very similar to what WealthChannel is doing. We're trying to promote education around alternative investments and help investors level up and learn more about how they can improve as a passive investor in this space. So first off, I mentioned we focus on macro trends, right? We're looking at where are the opportunities and what is the macroeconomic environment in this asset class. Let's talk a little bit about what's going on in oil and gas, because you may or may not be paying attention, and it's very, very interesting timing. So if you take nothing else away from the macro slide, this is probably the most important concept here is supply. We believe we are in a secular and structural supply constraint of oil and gas for the next probably decade plus for some pretty simple reasons. The simple reason is there has been a huge drop in investment into new oil and gas exploration and development. If you think about oil and gas, it's different than real estate, which generally appreciates. Oil and gas is a depleting resource, right? There's a finite amount of it in the ground. And so every year, most estimates are saying that 5 to 7% of our total production is depleted. And so just to maintain current production, we need to continue to drill new wells. We've seen a 50%, 50, decrease in investment over the past 7 years. And that's a huge issue because supply is not very quickly turned on, right? It takes several years to develop these oil fields and to get permitting and to get, prove out the reserves and to start the drilling and to build the infrastructure. So there's a lot of challenges, and part of the big reason why there's been a lack of private equity funding in the space, which has been the predominant portion of the funding in this space for so many years. And you see this kind of huge drop off in private equity funding. A lot of it is being driven by ESG. So environmental societal governance standards that are being mandated on these big capital allocators that are requiring them to invest in more green friendly investments. And they have, requirements they have to invest in these things. And so it's shifted a lot of capital away from this as a lot of this narrative is kind of being, pushed out. Meanwhile, there was a big kind of bubble a couple of years ago in oil and gas, and a lot of these funds got kind of scarred. And so they're kind of taking a step back, taking a back seat. And meanwhile, we're having a potential brewing crisis on our hands from a supply standpoint that's kind of starting to play out here. The other side of the equation is demand, right? Depends who you ask. And, some of the estimates from the more alternative energy focused, agencies are saying, hey, we're going to see a drop in demand. But by most measures, most, non-biased sources predict that demand will actually increase over the next 10 years, partly due or mostly due to population growth. And at a minimum will likely remain consistent, right? So you have, increasing or the same demand, you have, severely decreasing a limited supply. That does, usually one thing to prices that go up, right? Another thing that we like to pay attention to, and I think most people want to do, is follow what are the smart investors doing, and the value investors, value being purchasing, upside at a good value and a good discount. Warren Buffett is, the father of that. He's been betting big on oil. He's been buying a lot of oil and gas companies this year because he sees a lot of what we're seeing. And I don't have time to go into all the green energy kind of challenges of transitioning to green energy. A lot of people say, well, fossil fuels are irrelevant, right? We're going to be moved away from them in the next 7 years. Well, this chart alone should let you know that that's not the case. We're going to be fossil fuel dependent for probably the next 5+ decades in reality. Right now, only 17% of the global energy usage is coming from non-carbon sources like nuclear, hydro, wind, solar. And we've been, trying to develop these technologies and implement them at large scales for over the past 50 years. And we've made a nice little dent, but it's not much more than a dent, right? As far as total global energy consumption. Fossil fuels are required for transportation. It's the lowest cost, most high density energy source of fuel that we have. And there's some severe constraints on the minerals needed to continue to produce the green energy, like battery technology with lithium, cobalt, nickel. These are all mined, and there's not a whole lot of new permits being offered, especially in the United States, for new mining. So there's going to be some severe limitations on being able to substantially increase our reliance on alternative energies. Meanwhile, with this kind of supply challenge playing out, JP Morgan just actually released this. They're expecting by 2030, just 7 years from now, a 7.1 million barrel per day shortfall on a supply deficit. So they're estimating that based on the demand that is needed for fossil fuels relative to what's actually being supplied, and this is globally, this is across all sources, there's going to be a massive shortfall, putting a pretty large pressure and upside risk to oil prices. So this is something that not a lot of people are paying attention to. It's not getting a lot of the headlines, although there has been a lot more recently, as oil has been trending up quite a bit. It's gone up, I think, 40% over the past few months. And another kind of interesting piece of this that a lot of people don't realize is we have something called the Strategic Petroleum Reserve. They have been dumping this. This is generally used for emergencies like war, and we kind of keep reserves on hand. And you can see since 1985, we've not had this low of our Strategic Petroleum Reserve as we do now. And so this is how they've been suppressing some oil prices right now, but they're running low, and there's not a real easy way to turn on more supply. These are just a few forecasts of some big banks. We've already been hitting the 90-barrel oil right now. A lot of people are predicting hitting 100-barrel oil by the end of the year. And I say all that to say there's a lot of potential upside in this market. But, the way that we've built our model and our fund and the things I'm going to share about specific to the fund are all run on a $67 average per barrel oil, price per barrel oil. And so we're not building in any of the upside into the returns that I'm about to share with you here soon. So let's talk a little bit about our fund specifically. So this is a $50 million fund that we're raising. It's a diversified fund to go purchase a lot of interests across multiple operators, multiple basins. And we're focusing on two things. First is we're focusing on proven, developed, producing wells. So these are PDP. We're buying existing assets that are producing, which reduces risk, right? And then by doing that, we generally have optionality to participate in new drilling programs, which gives us upside. So our PUDs, our proven undeveloped reserves, and these are more considered infill drilling locations, so lower risk in new drilling. And we're focusing on what's called non-operated working interests. So these we are buying rights of the working interests of these wells alongside large operators. So we believe there's a very big opportunity. But as we've been investing in this space for several years, we've found in the kind of small scale mom and pop kind of operators, there's a lot of extra risks that I don't think investors should be taking to be able to have exposure to this upside. And so we're going and purchasing non-operated working interests alongside large operators and diversifying the fund across multiple wells, multiple basins, buying both cash flow and upside through new drilling. A little bit of an aside here, but for those that are newer to oil and gas, we put together this master class. It's about an hour and a half and goes into all the nuances of evaluating energy investments. We did this alongside our joint venture partner in this fund. You can click on that. It's a free resource. It's on YouTube. You can go to our website and find that. Real quick in the fund overview, I think I mentioned we were raising $50 million. We've already got over $40 million of equity commitments to the fund, and $100,000 minimum, 70-30 split. We are targeting 25 to 30% annualized returns. It's going to be a 10-year hold. So we don't necessarily plan to hold it that long. We're going to be opportunistic and when it's potentially a good time to sell earlier than that. But on that 10-year hold, a 4 to potentially 7x equity multiple on that with quarterly distributions. We will maintain a small amount of leverage to use for acquisitions, and we'll also employ a commodity price hedging program to reduce some of the downside risks in oil prices. Here's a quick little snapshot of our track record of our joint venture partner. This is our Fund 6 with our JV partner. They've had a very, very good track record where the lowest returning project that they've done is about 21%. On the highest one is trending over 80%. Key reasons to invest. I'm not going to go through all these. This is a longer presentation usually, but experienced sponsorship team. They've been in the space for 40 years. We're going after middle market opportunities with big operators. You get cash flow, you get upside, you get great tax benefits. And we believe it's right now is the best time to be investing in some of these opportunities given the current market. Just a little bit of the actual assets that we're looking at. So this is a fund. We're purchasing lots of assets. We just purchased our first asset. It was a $30 million purchase. So it's going to make up about half the fund. We bought this off market through existing relationships, and it's 143 wells. And it's producing about 358 net barrels per day of oil, almost 6,000 net MCF of gas, and 464 net NGL barrels per day. There's a lot of upside here. So we modeled this out at a 67 price per barrel oil to kind of hit those numbers I was talking about, that 25 to 30% returns. And we're one of the cool things is we're not paying for the upside. So we're buying the existing cash flow at about a 20 to 25% present value. So in real estate, we call that cap rate, right? Your unlevered cash on cash return over the hold period. We're buying this at effectively a 20 to 25% cap rate, right? If you can believe that. But in that, we're not even paying for any of the upside through new drilling. So there's 68 potential drilling locations already identified in this acreage. And the way that it works is if you get a PUD, basically description, it's the SEC term that is very difficult to get, proven undeveloped. So these are proven reserves in the ground. It's a matter of drilling and getting them out. It's not exploratory. It's not wildcatting. These are, in this basin. This is in the Scoopstack Basin, or region. This is about a 90% success rate on new drills, generating usually over 50% IRRs on a gross basis. So this first asset, we're purchasing 143 horizontal wells. These are non-operated working interests. Like I mentioned, 68 undeveloped locations, over 10,000 acres that we have mineral rights to, and ability to continue to drill. This is in the Scoopstack of the Anadarko Basin in Oklahoma, one of the most highly sought after oil drilling locations. It's got amazing takeaway capacity, which is a little bit of an aside, but they're not flaring any of the gas here. They have a lot of infrastructure built to take out all of the production. And here's just a little snapshot of some of our operating partners. So I mentioned our strategy here is going after middle market opportunities, institutional quality assets, horizontal wells, and we have of these 140 wells, 8 different operators. We actually have diversification across operators, and several of them are actually publicly traded. So Marathon, Continental, Devon, Cimarex, Aventiv are all publicly traded oil and gas companies that are very successful, great track records. We got some amazing tax benefits. If you're not familiar with oil and gas, real estate's amazing. I invest a lot in real estate. I love the tax benefits. Oil and gas is as good or better, depending on how you invest in these. So it's something that if you're, need some tax write-offs, definitely reach out to us and evaluate oil and gas. And I think I flew through this in a good amount of time, but if you want to get more information, you can reach out to our investor relations team, investorrelations@aspenfunds.us, or just go to our website, aspenfunds.us. You can call us at the number there. And I do have a little QR code here. We have an investor club that you can sign up for and get access to the data room to review this if you're interested in learning more about oil and gas, or just get our masterclass to just learn as much as you can.
Awesome. Ben, that was great. Well, yeah, I forgot to mention at the top of the show, we actually have several different asset classes presenting today. Our first 4 participants on the day are going to be presenting in oil and gas, which you just heard. We've got multifamily coming up. We've got self-storage, farming, and then in the afternoon, we've got a couple different residential and fixed income deals. So a lot of diversity here among our presenters today. We did have a few questions, Ben. We got a few times, a few minutes left, some time to answer some of them. So first question comes in from Brett here. He wants to know the returns that you showed, are those fund level or net to the LP?
Those are all net. Everything I showed was net.
Excellent. Khan asks, do you do all cash deals, or is there a loan component involved as well? And if so, what's the loan to value ratio?
Yeah, I addressed that really briefly. So great question. We have a small line of credit. So our $50 million fund will have a $15 million line of credit that we'll use to make acquisitions. It's, very accretive to the fund, and we are hedging the part of our production to limit any downside to cover interest coverage.
Good. A couple more questions here. By the way, if you're just joining us, if you do have any questions for Ben or any of our presenters throughout the course of the day, just use the Q&A tool in the Zoom toolbar, or use the chat. Type it into the chat. I'll see it either way. A couple more questions here. Let's see. This one asks, I understand that we are supply constrained with oil production due to policies in North America and Europe, especially. Is there a chance that oil prices can actually sustain $100 plus? And if it does, will it be harder for investors and funds to acquire assets?
Yeah, I don't want to prognosticate on oil prices and where they're going to, land long term. It's difficult to know exactly where it's going to land and if it can sustain. We've seen some kind of upward pressure once it hits 100. That does start to incentivize more production. But we've kind of been in this $80 to $100 range for a little while. That seems to be a sweet spot that OPEC likes. That's why I actually cut oil production recently to kind of boost some of that. So again, it's something that we think the thesis is going to play out over a 10-year period because of some of these severe supply constraints. Some estimates say that oil could go to 200 barrels, per $200 per barrel. Sorry, or higher, right? So we just don't know. We might see prices we've never seen before, but the whole point is we're not basing that into the model. You got to make it work at today's prices and actually yesterday's prices because we purchased this asset a few months ago and build your hedging around that. So that's our thought is make it work for the now. And if you get the upside, that's just gravy.
Good. Another question from Brett. If anyone here on the call wants to invest, is this an open-ended evergreen fund, or is there a deadline? Are you going to close it soon? How does that process work?
Yes, not open-ended. We had a 1-year raise kind of window. We're pretty farther along than we thought we'd be from the capital standpoint. We had 40 of the 50 million already committed. So we'll probably keep it open through year end. We may expand it if we find enough opportunities, which we're finding some good buying opportunities right now. So yeah, if you're interested, I would say before year end is probably a guarantee.
So a little bit of time to decide, but that won't be open forever. Last question, Ben, and then I'll cut you loose. We're just about at time. How soon will this offering potentially be cash flowing to LPs?
Yeah, great question. So we're cash flowing day one. So we're buying cash flow, which is great at a 20 to 25% cash on cash unlevered. The fund structure is to withhold distributions for the first year. And the reason we're doing that is because of the upside in the drilling. We can reinvest that 20, 25% IRRs back into new drilling, which are usually about 90% success rate, getting to 50% IRR. And that'll create this snowball effect that will continue to expand production. And then about the 1-year mark, we'll start making distributions, kind of targeting certain yields along the way to really build the upside. Our belief is that this is a generational opportunity to be selling oil over the next 10 years. So we want to build up as much production as we can. So it's really a total return focus with a lot of nice cash flow along the way.
Great. Well, Ben, thank you so much, you and Aspen Funds, for participating on Alts Expo today. We've run out of time. We were going to move on to our next segment, but thank you very much again. And I have posted a link to aspenfunds.us in the chat. Open up the chat if you want that link. And I've also posted a link to that oil and gas masterclass that Ben referenced as well. So please go check that out and let Ben know if you would like to request subscription documents and invest with Aspen Funds. Ben, thanks again so much. Appreciate your time.
Thanks, Jimmy. Thanks, everybody. Appreciate it.